Good morning, Terry Dyer here. I'm a real estate broker. I'm also a mortgage broker. I own a company called Realty San Diego, and my partner, Debbie Nelson, owns Hanson Loans. Together, she and I have been helping San Diegans buy homes, sell homes, buy all types of real estate, build their portfolios of real estate, and all of this over the last 20 years. It's been fantastic, and we're still here, and we're still making it happen for our clients. A lot of our clients today are first-time buyers, as has always been the case. And the biggest problem or objection or barrier to ownership that most of our first-time buyer clients have is, where's the money for the down payment? Sure, you got a great job. Sure, you have good credit. Sure, you can make the payments. But you just don't have the down payment, the money for closing costs. I mean, on a $500,000 loan or $600,000 loan here in San Diego, even that is kind of a tough. It's tough to find a home for $500,000 or $600,000 in San Diego. But let's say that you find a home for $500,000 or $600,000, and you're going to need 3 or 4% of that purchase price just for the closing costs and down payment, right? Okay, so a lot of people say, well, I'll just save the money and, in X number of years, I'll have it. Well, X number of years comes, and guess what? That house is more expensive. Life has happened. You haven't been able to save the money. And so what happens is people keep getting pushed further and further back in the road to home ownership. So let me show you how we can make that a shorter trip for you. And I'm going to do it with the state of California because the state of California wants you all to be homeowners. And so what they're going to do is the state of California is going to loan you the money for your closing cost and for your down payment. What's even better about that is they're not even going to ask you to pay the money back until you sell your house or refinance sometime down the line. So why is this fantastic? Well, here is the money for the down payment and closing costs. You don't have to make a payment. And because you're not making a payment, there's no payment factored into your debt ratio for that second, right? For the money for the down payment. So it's just money. You owe it, sure. But what are you going to pay it back with? You're going to pay it back with the house. The equity from the house. So you're going to borrow the money to buy the house, right? Then you're going to let the house appreciate. Then you're going to use the house to pay back the money that you borrowed to buy the house and get the appreciation in the first place. It's magical. I'm telling you. If you don't take advantage of this program, then, well, you're not going to be a homeowner if the only objection to being a homeowner is coming up with the money to buy the house, the down payment. Let me show you how this works, okay? Here we go. The CALHFA loan program, sponsored by the California Housing Finance Agency. And I put in here 3 scenarios, okay, of what the numbers would look like. They're all going to be based, all 3 scenarios are going to be based on 2 homeowners buying a home in San Diego County for $575,000. And I'm going to assume that there's a credit score we're using of $680,000. $680,000. A credit score of 680, excuse me. And for this example, it's going to be a single family home. And let's say closing costs are 3% of the purchase price. So $18,000 is a little bit more than 3% of $575, but it's close enough. Okay? So let's go down here. And what I'm going to do is a Cal Plus conventional with a ZIP 3%. Okay, so what that means, it's a conventional loan, which means it's not FHA, and it's not VA, otherwise government insured. So it's not a government insured loan. Okay, ZIP is the amount of interest you're going to pay on a 3% loan for your closing costs. So 3%, that 3% money up here that we're talking about, $18,000, is right here. That's where it's expressed. Okay, and you're not going to pay any interest on that money, and you're going to get, because these rates are sponsored by the state of California. Don't forget these programs are sponsored by the state of California, and as such, the interest rates come from the state of California. I have nothing to do with them. So let's see, Cal Plus Conventional with ZIP plus 3. Cal Plus Conventional with ZIP plus 3, 0 interest program is 5.625. Do I have that in there, 5.625? I do, so don't know where the 3 came from. All right, 5.625. And then it says over here we have a high cost premium of 0.876. So let's see, Cal Plus Conventional ZIP of 0.876. Okay, so I got that in there, that's right. Now, but the question is, what if 3% of the closing cost isn't enough? What if you need some more money? Well, let's add another 1% to that, okay? Now we've got the Cal Plus Conventional, right, non-government, with 0 interest on a 4% loan that can only be used for your closing costs. Okay? Well, we're getting more money as a down payment, as a basically given to us for use to buy the home. And well, of course, you know, the state of California, we're going to have a little bit higher interest rate on that because we're borrowing more money. So in this case, the interest rate is a little bit higher at 6%, and the high balance fee is also a little bit higher. So we've got that in there. So here's another way to buy the same home. And lastly, let's do an FHA, okay? The reason we're going to do an FHA is because sometimes people have something in their credit history that hasn't done what they call seasoned sufficiently, meaning maybe there's a bankruptcy or a short sale or some major credit event that happened in the last 2 or 3 years that Fannie Mae and Freddie Mac aren't so fond of, but yet the FHA will make an exception for, okay? So that's why we have that on there, using the FHA. The reason I don't like to use the FHA is because the FHA has an additional fee for the FHA insurance, okay? So, unless we need to use the FHA version because of some, as I said, credit event, we would not. However, that said, there are the benefits. But nevertheless, let's go over here and look at these scenarios, okay? Remember, let's review this. We're buying a $575,000 single-family home. There's a credit score of 680. We need $18,000 for our closing costs, and that's what we're going to see here on example number 1. Is Cal Plus Conventional with Zip Plus 3, okay? So we got a $546 loan amount, a $4,700 high balance fee, and the first loan amount is, as I said, $546,250. The second is $20,125. This is for your down. This is for your down payment, okay? This $16,000 is for your closing costs. So the state of California is going to loan you $36,000 to buy this home in example number 1. In example number 2, they're going to loan you about $41,000. In example number 3, they're going to loan you $42,000, which is the FHA version. Okay? So example number 1, you're going to have a 3% loan from the state for your closing costs. Example number 2, you're going to have 4%. Example number 3, you're also going to have 4% with the FHA. So here's where that makes a difference right here. You've got a loan right there for $20,000 for your down payment. You've got a loan for $16,000 for closing costs. And the first loan is going to be a 95% loan to value, meaning that you owe 95% of the value of that home, assuming it's $575,000. But when you add the second and basically a third, this other $36,000 that the state of California is letting you borrow at essentially no interest, when you add that to it, you actually owe a little bit more than what the house is worth. The fantastic thing about this is, one, instead of you having to come in with not only this $36,000 plus this $15,000, that's $50,000. Instead of you having to come in with $51,000, you only have to come in with $15,000. For $15,000, you control that $575,000 piece of property. That property goes up 3% a year. You own that 3% equity. That's $15,000, $16,000. If it does that by 10 years, well, guess what? You sell that house, you're going to pay back these 2 loans right here and have some money left over for you. You're going to have the benefit of home ownership for you and your family, most importantly. So go over to scenario number 2, if you will. Cal Plus Conventional Zip Plus 4. This gives you an extra 1% for your down payment. So you see that right there in $16,387 for your closing. I said down payment. I'm not closing cost. Excuse me. Here's for your closing cost is $16,387, and then over here we ask for another 1% for closing costs. So we have $21,815. And what that means is we owe, or don't owe, but we need a little bit less to come in to escrow to close, $11,000. So think about it again. You're buying almost a $575,000 house, and we're going to need you to bring to escrow $11,400. Now, if I can get the seller to pay $5,000, make a little bit of a contribution towards your closing cost, I can actually get this down very close to 0. I do it all the time. So here's the thing, guys. Okay, your payment is going to be a little bit higher because you have a little bit higher the interest rate. 30-year fixed rates right now are right under 5% anyway. So, you know, you're borrowing this money, you're getting great terms on it. The interest rate isn't terribly higher than what it would be if you had 20% down anyway. So then you get the benefit utilization of the house, the appreciation of the house. You don't have to, make payments on the money that you got for the down payment or the closing cost. I mean, it doesn't really get much better. So let's take a look at how it ends up. We have the principal and interest payment right here. This 30-year fixed, $32.75. And then you have property tax. Assume that's like 1.25% of the principal of the purchase price. Your homeowner's insurance right here is probably overestimated by about 50 or 60 bucks, but close enough. And then your mortgage insurance every month is $277. So that would give you a principal and interest and all the taxes and insurance payment of $42.95. Now, of course, you're not seeing any payment in here for this $42,000, are you? Because you don't ever make a payment on it. You make one payment. That's when you pay it off. Okay? You can make payments on it if you want to, but you don't have to. And lastly, the least expensive way to get into this house, as far as cash out of pocket, is to go with the FHA option. Yeah, it's a little bit more expensive because you have the insurance, but the FHA comes in, you come in with a little bit more money. And guess what? For under $5,000, here it is, for under $5,000, you're going to own that $575,000 house. Do you have $5,000 in your bank account right now? Probably, but here's the thing. When you qualify for this $5,000, let's talk about what that means to qualify. We can't have your debt ratio be any more than 45%, okay? 45% DTI, debt to income. So what that means is if you make $10,000 a month, this payment right here of $4,500 would put you at a 45.2% debt ratio, right? So you'd actually have to make about $11,000 a month to qualify for this payment. That's household income. Now, if you had a car payment and other debt, then we'd have to account for that too. So you take your car payment, your credit cards, and whatever, and then you would add all that up, and your new house payment that could not exceed 45% of your gross monthly income. Okay? That's about it. It's not hard to qualify. If you have the credit and you have the income, we can get you there. All right? Give me a call at 619-339-8253. I want to invite you to talk to Debbie Nelson, who owns Hanson Loans. Let's get you qualified to buy a home, and I'm going to help you find a home. It's going to be fantastic. So many of our clients are so happy that they found this program. It's worked great for them over the years. They've used the appreciation from their homes to pay the down payment back, and so they got the benefit of using their house to pay for their house. It's great, right? Okay. All right. Well, I look forward to helping you. Give us a call back at 619-339-8253. That's my number. I'm the real estate broker. Or call Debbie Nelson at 619-200-9570. Let us know you saw this on Facebook, and we look forward to talking to you, okay? You have a great day. Thanks.